In this video, guys, we'll look at how you choose the right market to trade if you are a beginner. Stay tuned. Hey traders, warm welcome to you. All right, so let's say you have chosen to trade. You've decided that you want to allocate some risk capital in the markets. You've gone to the link in the description below, opened an account, and you've said, right, these are the markets or some of the markets that is offered. How do I decide exactly what I'm going to trade? So it's a multi-step process. And if you're a beginner, it can be daunting. I get it. There's so many things to trade. Someone says, hey, can we trade gold? Someone says, no, trade crude oil. Trade indices, trade the FTSE, trade the stocks, trade commodities, trade crypto, trade Forex. And everyone's shouting and saying it's the next best thing since sliced bread. Now listen, it's very much going to depend on your individual circumstances, the amount of time you can trade, the amount of capital you have to trade, and a little bit your personality. Now, I'm a big believer in there's no real right or wrong way to trade. I know traders who are doing very, very well, trading a very obscure setup and strategy on unusual markets. Equally, I know traders who are doing very well, who are trading some of the major markets. But the key that I will say now is that they all have something specific that they look for. They're known, or we know them as traders who trade a specific way. They've got a little flavor, a little twist, a little setup, something they look for. So I don't think it matters too much about choosing the market for now. If you get it wrong, per se, get it wrong. If you don't like how you're trading, you can always change. I'd never say change and just go back and forth different things all the time. But if you start the process with a little bit more of a method and think a bit more about what you want to trade, then life becomes a little bit easier. So let's get around to it. Okay, so broadly speaking, you've got your indices, you've got some crypto, you've got US stocks, and you've got commodities. So which is the best? Now, one thing to say, guys, about volatility is it's very cyclical. As I'm filming this, the Forex volatility is compressed massively. But a couple of months ago, it was huge. Now, of course, that was because of a geopolitical event or some kind of event that was hitting everything. But so often you get volatility moving from commodities to indices, to the stocks, obviously they go in tandem with the indices, to the currencies, to crypto. And listen, sometimes everything's going to be volatile depending on what's happening, but very often there's going to be pockets of volatility. So bear that in mind. So if you're trading Forex, the major pairs that everyone likes to trade are Euro USD, GBP USD, USD JPY. You've got others like AUD USD. You've got some less popular ones like GBP JPY. I could go on forever. And guys, if you want to check them out, go and check markets that you can trade and the spreads as well, because you've got different account types and depending on how frequently you're trading, the style you're trading. So it's a very personal thing. But anyway, if you're choosing to trade Forex, the advantage, of course, 24/5. So you can trade Forex from Sunday night, if you look in the UK, all the way through to Friday evening. So if you're up at 3 o'clock in the morning and your lifestyle is that, hey, I've got other commitments and I can only allocate time from midnight to 2, for example, then you can still trade maybe JPY, one of the JPY pairs, knowing that Japan might well be more active. So you get the option with Forex, very, very flexible instruments to trade, or very, very flexible markets to trade. You're not going to get the gaps. Some people like the gaps, well, we'll talk about those in a moment with the US stocks, but you're not going to get that apart from the weekend if you're trading Forex as well. Very, very liquid. Spreads are very, very narrow, probably the narrowest of all the things here, just purely because the liquidity is so big. More liquidity on the underlying means that the broker can offer you a tighter spread and pass that on to you. So that's one of the reasons guys will trade Forex. Now, indices are obviously a basket of stocks, depending on which country you're looking at. So US 500 is basically the equivalent of the S&P 500. It's equivalent of the S&P 500. A UK 100 is FTSE 100 equivalent, and US 100 will be the NASDAQ 100. So when you're trading these, now whilst they will trade not necessarily just in line with the regular trading hours like a US stock, so you can get some after hours movement. So the FTSE, for example, closes at 4:30 officially. That's a cash price close, but you'll be able to trade that after 4:30 during the US session. Spreads are reasonably tight as well because the liquidity is there. So if you're day trading them, you're okay with your Forex, you're okay with your indices because of the tight spreads. A slightly different way of movement. I think that there's little subtleties with Forex as there is with indices. With indices, you're trading a basket of stocks, so supply demand based on those basket of stocks. When you're trading a currency pair, don't forget you're trading one against the other. You're long one currency and short the other, so it's automatically a bit of a pair trade. It's a little bit like going long US 500 and short UK 100. You're betting on the strength of one and the weakness of the other and the ratio between the two. So I think that some of the moves are a little bit more aggressive on the indices. It's far more defined chunks of movement as well, in my opinion. So you get the open, let's say you get the open 8 o'clock UK time for your European markets. That would be, you know, your German 30, your DAX equivalent UK 100, and then you get the open in the afternoon, about 2:30, where it's 2:30 UK time, is the open for the US markets, and then you get a burst of volatility, then it dies down. So if you like that burst of volatility, you know, trading indices might be something for you, especially if you've got, let's say you've got a couple of hours in the morning, you can prepare from 7 o'clock until say 9 o'clock, then you might just choose to trade some of the European indices that way. Of course, you know, when the money's flowing around the world, then the currencies are going to see that as well. If you get the US markets open, the US dollar is going to move and stuff, but it's far more defined, I feel, on the indices. Then you've got commodities like gold, silver, crude oil. These guys have their own little nuances. They've got their own supply and demand, they're in their own little bubble. Now, of course, the general economy does affect the price of crude oil, it does affect the price of all these commodities, but they tend to have little nuances based on supply demand because of the way they're traded, because you've got the consumers, you've got the producers. So you can just focus solely on your commodities. You can say, right, I'm just going to trade crude oil. And because there's a lot of liquidity there as well, spreads are reasonable so that you can trade them intraday if you want to be a day trader. You can just focus on your precious metals, so you can trade your silver, your gold. Maybe you can look at the ratio between the two. So you can become a bit of a specialist in commodities as well. Now, crypto, as we know, can be super volatile. These things can rip and rip and rip and rip. Spreads a little bit wider than you get for, let's say, your Forex, your indices and your commodities, purely because that's what it's like in the underlying guys. The liquidity is not quite as much, and so the broker just has to pass on what their costs are. So a little bit wider, so maybe you're not going to be as active trading as you would be with those. If you're looking for something super active intraday, probably stay away from the crypto. But if you've got a view and you like to trade the supply demand imbalance on these that can happen, then obviously you've got access to Bitcoin, your XRP and your Ethereum there. Right, US stocks. I quite like trading US stocks. I like the fact that you get the closing bell and then you get a gap the next day. So that's one of the things that is unique, perhaps, to US stocks, that is different from all these others. You know, these are all trading around the clock pretty much, with some exceptions. But US stocks, you're going to open from my time, which is from the UK, 2:30 till 9 o'clock. And then that's it. The next time they open again, they may well gap, which can be a downside, because if you kind of don't like the fact that you give up control of your risk overnight, you're probably better off trading Forex. But if you're okay with gaps and you like maybe trading off gaps and intraday trading off gaps and using those as a bit of a supply demand gauge, then that works quite nicely. Of course, US stocks, you've got Apple, Amazon, Facebook. Spreads are going to be a little bit wider than they would be for the broader indices, purely because the underlying, of course, isn't going to be as liquid as these. Although Apple, pretty liquid, Amazon, pretty liquid, the big guys are going to be pretty liquid. So you can intraday trade them because the volatility on some of these can be really extreme as well intraday, and you can pick up trades for swing trading. Margins requirements slightly different for each one of these, slightly less for Forex compared to, say, crypto and US stocks, but it depends what you're trading. Depends on the margin you've got in your account, depends what account type you've got, depends what you're looking for. Are you swing trading, are you day trading, are you holding stuff overnight? All these kind of little different things are to be considered, but the main things are, when can I trade? In other words, what time of day have you got? Do you want to be sitting in front of the screen? You prefer to be a day trader? You prefer to hold stuff overnight? What sort of risk do you want to take? Are you prepared to take gap risk? And now there's pros and cons with that. Gap risk means that once it's closed, you can't do anything with it. Whereas Forex, maybe you can get out at a position you want, or get stopped out overnight, or get a limit order filled overnight. But then that might mean that you're constantly focused on what's happening. So, you know, it swings and roundabouts depending on the type of trader you are. So have a think. I would say that focusing on one specific asset class is a better way of doing it as a beginner trader. If I was starting out from scratch, that's what I would do. I'd say, right, I'm just going to focus solely on indices. I'm going to pick 2 of those, or solely on Forex. I'm going to pick 2 of those. I'm going to trade them during these hours. I'm going to trade them with this size, and then I'm going to look at my setups and strategies from that. So choosing the right market to trade if you're a beginner. You've got loads of choice, especially if you trade them via MT4, of course. And you look at the pros and cons. So have a think. If you're a new trader, work out when you're going to trade, the type of things you want to trade, and focus on those for a bit and see how you get on. You can always move and trade something else further down the line. That's the beauty of the markets. We've got great technology these days. We've got access to so many markets. It's a great time to be a trader. Take care, guys. Description below. I'll see you in the next one. Bye-bye.